Hi, I'm Dan Passarelli here for CBOE TV. Well, this is the fourth and final installment in my vertical spreads series that I've been doing over the last 4 weeks. And I want to talk about one really practical use for vertical spreads that maybe a lot of traders out there aren't aware of. It's using a bull call spread to trade a potential takeover target. So when a company is rumored or expected to be taken over, here's what tends to happen in the options world. Those options on that stock tend to get a lot more expensive. Implied volatility rises in that stock because what everybody's looking for is they're looking for the stock to rise to the upside. So they buy calls. So the problem is, if the takeover doesn't happen, then the stock doesn't go up, so the trader doesn't make money on the calls, and the volatility goes down, so the trader loses money on the calls. So there's an element of extra added risk, and if you don't know how to play it, you can run into trouble. And another thing to think about with takeovers is that usually the rumor mill speculates that there's a specific price where the stock is likely to be taken over at. For example, if the stock is trading at $60 a share, maybe the takeover price could be expected to be $65 a share. So with the takeover situation, traders are never looking for a large runaway profit. They're looking for a one-day big pop, and that's it. So the solution to the problem of hedging off the volatility risk and the ability to trade successfully in a situation where the stock rises to a certain level but the trader doesn't expect it to go higher can be solved by trading a bull call spread. Very simple, common vertical spread. The trader would buy the call that he wants to buy to ideally make money if the stock rises, but the trader would sell another call that corresponds to the level where he expects the stock to be taken over. So for example, if the stock right now is at $60 a share and I expect the stock to be taken over at $65 a share, I would buy the 60 strike calls and I would sell the 65 strike calls. What this does is it hedges off that large amount of implied volatility risk because the option I'm buying gives me that positive exposure to volatility. The option I'm selling gives me negative exposure to volatility, so they somewhat offset each other. Usually when I trade a bull call spread like this, I'm concerned about giving up the upside, but in a situation like a takeover, I'm not concerned about giving up the upside above $65 a share in this example. So using a bull call spread to trade a takeover situation is a very, very practical way to trade it, one that many traders down on the trading floor look at, and one that a lot of my successful students look at as well. This is Dan Passarelli with Market Taker Mentoring, here for CBOE TV.